Hi, I'm David Offenberg. I'm an associate professor of finance at Loyola Marymount University. I'm joined, as usual, by my colleague Josh Spisman, also an associate professor of finance at LMU. Josh, what a weird week for video games. On one end, the new end, we have Roblox doing their IPO. Well, their direct listing, their stock is
That's right.
trading. I have shares. You have shares?
I don't.
And
I wish I did.
I'm exaggerating. I have one share. One
Okay.
share. On the other end, the old end, it's GameStop, and
hmm
GameStop is still kind of a thing. But the stock is a thing. But what's happening with the bonds? Let's talk about the bonds today.
Yeah, I'd love to talk about the bonds because we keep hearing about the stocks and the stock prices going crazy. But the bonds tell actually quite a different story. And so when we're looking at the bonds here in this graph, which in the top figure is the bond price. And the bottom figure with the green line is the bond yield. And what we can see is, going back to December when sort of all this stuff was beginning with GameStop, the bond price did react a little bit. And in January when we had that crazy week, and you can go back and watch our video about a short squeeze, the bond price did go up, and there's an inverse relationship between the price and the yield of a bond. So you basically are seeing that inverse relationship here very clearly.
And do
But
you have a good reason for why the bond price would go up just because people were monkeying around in the stock market?
that's a great question, and some of it I would speculate is what we talked about with AMC, where when that stock price went up, that in theory gave the GameStop a chance to issue some new equity and maybe pay off some of these bonds. And unfortunately, fortunately or unfortunately, but they didn't do that. And so that could also be where we see that reaction where the bond price went up and then it sort of came back down a little bit.
Interesting.
And yeah, and the other thing is if we look at the bond price compared to the stock price. So here the white line with the shaded region, that's the stock price, and that's sort of what that you can really see the craziness that's been happening in GameStop. We see that huge run up that we in late January that we talked about, and frankly the last 2 weeks or so we're seeing another run up with GameStop stock. But this blue line that
I
is
don't see the line you're talking about. What are you talking about here? There's no line.
yeah, I know, right? It's basically this blue sort of straight line that's
Oh,
just going
there it
across.
is.
That is the bond price. And the bond price, if you really look at it relative to the stock price, it's not moving much at all. We're not seeing that huge gain. We're not seeing the big dip. We didn't see much going on there as well. And I think a lot of this has to do with the payoff structure of bonds versus stocks. And so, we keep talking about taking theory to practice, and sometimes the theories are pretty simple. And I think in this case, it's a very simple, explanation for part of what's happening, because the theory of GameStop from the stock perspective is that you have to believe there's going to be some turnaround, that the store that you're standing in front of right now, that they're going to figure something out, whether you go there to buy ice cream cones or whether you go, they figure out how to do something online where they're going to sell video games online. I don't know the answer, but there has to be some turnaround so that these stockholders can get paid off in the future. But with bondholders, they're capped. And basically, what we're looking at here is just a theoretical, concept. This is not GameStop. This is just some company that has bonds that basically the bonds are going to receive $50 per year, in interest payments, let's say. Well, if the cash available is less than 50, the bondholders are going to get all of it. And you can see that in this early part where the bondholders are just going to get all of the, everything. And then once it hits 50, that's what the bondholders keep collecting 50. Now, what happens though, is if the cash available increases. And so here we see the cash available increase. And now in my nice LMU red, we see the stockholders come into play. So the bondholders are going to get $50 no matter what. In this case, we're seeing, the firm has been able to generate up to $100 of cash. And they get that $100 of cash, and the stockholders get the rest of it. We call this, they're the residual claimant. So they're getting all the residual after the bondholders get paid off. And this is fine. And some stockholders will be happy about this. What GameStop stockholders are hoping for is something like this, where the cash flows are going to reach astronomical levels. $400, let's say, in this case, $400. Guess what the bondholders get? 50. It doesn't matter how well the firm does. The bondholders are only going to get paid what's promised to them, which is $50. But all that extra money goes to the stockholders. So if GameStop has a huge turnaround and can generate, massive amounts of cash, the bondholders are capped at are limited at what they can actually receive and get paid off on. The stockholders are going to get everything left over. And so that's really, I think it goes back to the payoff structure of stocks versus bonds, why we see a lot more volatility with the stockholders and a lot less for those bond prices.
That makes so much sense. And Josh, the best time of year to be a residual claimant?
I don't.
Parent on Halloween. Parent on Halloween.
That's right.
My kids bring home candy. No matter how much candy they bring home, they're only getting 3 pieces. Residual claimant, right here.
I'm going to take that next Halloween for my kids. That's a great idea, David.
Well, thanks for explaining this. It all makes so much sense.